Welcome to Simple Investing Secrets. In this video, we'll review the top 10 REITs that pay monthly dividends. So before we start, kindly like this video and subscribe to our channel for weekly updates. Let's get started. Income investors have a soft spot in their hearts for real estate investment trusts, also referred to as REITs. Because REITs are required to distribute at least 90% of their taxable income to shareholders in the form of dividends, they have the potential to be an excellent source of passive income that also offers attractive dividend returns. Quarterly dividends are nice, but wouldn't it be great to have regular dividend income you can count on every month? One way is to take some spare cash and build a basket of monthly dividend-paying real estate investment trusts, REITs. With REIT prices down so much this year and dividend yields so high, now is a great time to pick up some high monthly income payers. A good REIT basket, however, should have sector diversity, a respectable dividend yield and a careful selection of the REITs and funds from operations, FFO, that will cover the dividend payments to prevent dividend cuts. You can build a basket with a lump sum of money divided evenly among all 5 REITs or just buy an equal amount of shares of each. Here are 10 REITs that fit the above criteria and could provide safe and dependable monthly income. Number 10. Apple Hospitality REIT Incorporated, ticker, APLE. Apple Hospitality REIT is a REIT that invests in upscale hotels in the United States. Its extensive portfolio includes 220 hotels with about 29,000 guest rooms. Those hotels span 87 markets across 37 states. They include hotels in leading brands, such as Marriott and Hilton. The main benefit to investors is this REIT's large portfolio that invests in major hotel brands and its dividend yield of 6.19%. Number 9. EPR Properties, ticker, EPR. EPR Properties describes itself as an experiential REIT. It invests in commercial properties, primarily focused on entertainment. This includes amusement parks, movie theaters and ski resorts. Its current investment portfolio contains $6.7 billion worth of assets, and the company claims its market potential exceeds $100 billion. The dividend yield for EPR Properties is 8.59% and potentially has a lot of room to grow its portfolio. Number 8. Main Street Capital Corporation, ticker, MAIN. Main Street Capital Corporation is a private equity firm that invests in lower middle market companies with revenues between $10 million and $150 million. The company has been around since the mid-1990s. In that time, it has helped over 200 private companies grow. It focuses on companies with strong competitive advantages, stable and positive cash flow and seasoned management teams with established track records. The company's current dividend yield as of March 2023 is 6.79%. It has a track record of success and solid recent earnings. Number 7. Agree Realty Corporation, ticker, ADC. Agree Realty pays a 3.61% annualized dividend and trades on the New York Stock Exchange with an average daily volume of 815,000 shares. The monthly dividend payment is 23 cents per share. The company is primarily focused on the ownership, acquisition, development and management of retail properties net leased to industry-leading tenants. It focuses on owning properties leased to essential retailers such as grocery stores, home improvement, dollar stores and drug stores, which are less susceptible to disruption from e-commerce or a recession. This strategy enables Agree Realty to generate steady rental income to support its dividend. Agree Realty switched from a quarterly to a monthly dividend payment schedule in January 2021. It has an excellent dividend track record overall. This REIT has increased its dividend at a 5.5% compound annual rate over the past decade. Agree has been in business since 1971 and has been publicly traded since its 1994 initial public offering. Credit Suisse Group AG analysts initiated coverage of the REIT in June with an outperform rating. Bank of America Corporation in June upgraded Agree from neutral to buy. Agree Realty has a strong balance sheet to help finance its continued expansion. That leads it to forecast acquiring another $1.1 billion to $1.3 billion of properties in 2023 to support continued dividend growth. Number 7. Broadmark Realty Capital Incorporated, ticker, BRMK. BRMK provides short-term lending to real estate investors and property developers in the form of first-position deeds of trust and mortgages. The funding provided by Broadmark is typically used to fund the purchase and/or development and renovation of both residential and commercial real estate assets. The average loan size provided by Broadmark is about $7 million. Broadmark has been around for about 12 years and has funded over 1,200 loans worth just less than $4 billion. The company has a current loan portfolio worth around $1.6 billion, with real estate assets securing 227 loans located in 20 states. Broadmark is on our list because of its consistently high monthly dividend, currently 7 cents per month or about 12%, its strong underwriting and the fact that alternative lending, like what the company offers, is likely to become more popular in the next year or so as traditional banks tighten their lending standards. Number 6. AGNC Investment Corporation, ticker, AGNC. Despite a slowing housing market, real estate stocks tend to do quite well during periods of inflation, and they're known as some of the best picks for monthly dividend investors. AGNC Investment Corporation is a REIT that invests in mortgages. REITs enjoy a number of tax benefits and have to pay out at least 90% of their taxable income to shareholders. AGNC has been paying out monthly dividends of 12 cents per share for a long time. Because AGNC invests primarily in large, federal guaranteed loans, backed by the likes of Fannie Mae and Freddie Mac, this stock is seen as a fairly low-risk option despite its 12% dividend yield. Based on the company's preliminary results for the third quarter, it had a total investment portfolio of $61.5 billion at the end of September 2022, of which only $1.7 billion was in assets that were not agency or credit risk transfer assets. Almost the entire portfolio is comprised of agency assets, which are protected by the federal government in the event of default. There's quite a bit of safety built into AGNC's supercharged yield. AGNC is on our list because it has a high monthly dividend, invests in low-risk assets, and gives investors some peace of mind in an economy that is becoming more unstable. Number 5. Realty Income Corporation, ticker, O. Realty Income is a retail REIT with over 11,400 worldwide commercial properties on long-term net leases. Its tenants are large well-known companies like Walgreens Company, Dollar Tree Incorporated, and FedEx Corporation. Its portfolio is huge, with over 11,700 properties. Realty Income has an investment-grade rated balance sheet, and its shares are generally afforded a premium to its peers, which leads to lower capital costs. When you put all of these factors together, Realty Income has the ability to keep doing deals even when market conditions are tough. And as it expands, it can continue to support higher dividends. A key differentiating factor is that it can also handle larger deals that smaller peers couldn't even consider, which gives it more avenues for growth over the long term. Realty Income is one of the most popular well-followed REITs. It's one of only 65 S&P 500 dividend aristocrats because it has increased its dividends 117 times for at least 25 consecutive years. The annual FFO of $4.92 easily covers the annual $2.98 dividend, which now yields 4.71%. Number 4. EPR Properties, ticker, EPR. EPR Properties is a diversified experiential REIT that owns and operates 358 movie theater chains, amusement parks, resorts and other recreational venues. It secures these properties by signing triple net leases with the venue operators, meaning the tenants bear the responsibility for building insurance, maintenance, and real estate taxes. The 2020 pandemic forced EPR Properties to cut its quarterly dividend from $0.385 to 25 cents, but it has since been raised to $0.275. EPR Properties stock fell from $54 to $35 in August as a result of its movie theater tenant Cineworld Group plc filing for Chapter 11 bankruptcy, but it has since increased by 11.5%. With a yield of 8.19%, the annual FFO of $4.67 easily covers the dividend of $3.20. EPR Properties has demonstrated remarkable resilience in the past, and it should be able to overcome the current risks to continue providing reliable income each month. However, a bad recession or more theaters filing Chapter 11 could result in a dividend cut or price decline. It entered 2022 with lots of liquidity and a strong balance sheet, giving it the cash to acquire more experiential real estate. With movie theaters facing disruption from online streaming, EPR plans to acquire more attraction-related properties that consumers can only experience outside the home. That could improve its dividends' long-term durability. Number 3. LTC Properties Incorporated, ticker, LTC. LTC Properties is a healthcare REIT that owns and leases 202 senior housing and skilled nursing facilities in 29 states across the country. Mortgages, mezzanine loans, and triple net leases all contribute to LTC Properties income. The pandemic hit the senior housing sector hard, impacting LTC Properties tenants. Several struggled to pay rent, which led some to file for bankruptcy. However, this REIT used its financial strength to weather the storm and offset some of the lost income with new investments. That's allowed it to maintain its monthly dividend. With a yield of 5.86%, the annual FFO of $2.54 pays the $2.28 dividend. While not a huge margin of safety, third quarter FFO of 63 cents was 8 cents higher than the year-ago period, and management recently guided an increase in fourth quarter FFO of 9 cents to 10 cents per share. As the pandemic ends, the market should get better, so LTC Properties rental income should go up in 2023. When recent investments are taken into account, this REIT's high monthly dividend seems like it will last. Number 2. SL Green Realty Corporation, ticker, SLG. SL Green Realty is an office REIT and the largest office landlord in New York City. The REIT owns 62 buildings totaling 33.6 million square feet. While the city's office sector has faced some pandemic-related challenges, SL Green has held up relatively well. That's due in large part to its focus on owning some of the highest quality office properties in the city. That's benefiting this REIT as the city's office market recovers and tenants focus on leasing quality space for their employees. This office REIT exceeded its leasing target in 2022 and expects to sign even more leases in 2023. The demand shows that companies expect to return to their Big Apple offices in the future. SL Green is not a well-loved stock on Wall Street because of fears that at-home workers will not return to office work. Short interest is also very high. But the price to FFO of 5.67 indicates that much of that fear is already baked into the stock price. The annual FFO of $6.70 provides huge shade over the yearly dividend of $3.73 and yields a whopping 9.83%. At a recent price below $38, it seems to have more upside potential than downside risk. With market conditions on the upswing and new developments paying off, SL Green should be able to continue expanding its dividend in the future. Number 1. STAG Industrial Incorporated, ticker, STAG. One company that has greatly benefited from the growth of e-commerce is STAG Industrial. This REIT specializes in the operation of industrial and logistics warehouses, with roughly 40% of its portfolio directly servicing the e-commerce industry. Given today's market volatility, share prices are down almost 11% year to date, making it a great time to double down on this dividend-paying growth stock. STAG is one of the largest industrial REITs in the space, with interest or ownership in 517 buildings for a total of 103.4 million square feet of leasable industrial space across 60 metro markets. While e-commerce is the primary industry it serves, it's diversified across 45 different industries within this sector. STAG Industrial owns and operates 563 single-tenant industrial properties across 41 states. Amazon.com Incorporated is STAG Industrial's largest tenant and accounts for about 3% of its total rent. E-commerce isn't slowing down, if anything, it's gaining momentum. The more demand we see for online shopping, fast shipping, and easy returns, the more demand there will be for industrial space. STAG Industrial's third quarter earnings were good and the core FFO of 57 cents beat last year's same quarter results of 53 cents per diluted share. The annual FFO of $2.20 covers the $1.46 dividend and yields 4.59%. In addition, STAG is one of the higher dividend-paying industrial REITs with 10 years of consistent dividend raises. STAG is favorably valued as it relates to its performance. It has clear long-term demand drivers and major opportunities for growth, given its acquisition activity and exposure to the e-commerce market. This concludes our list of the top 10 REITs that pay monthly dividends. As always, it is essential to do your due diligence before committing your hard-earned cash to buying stocks or investing in the market. Don't forget to like this video and subscribe to our channel for weekly updates on the best stocks to buy and cutting-edge investment strategies for building wealth. Thank you for watching and happy investing.